Welcome to Wizards Institute, the #1 community to learn smart investing and financial independence.
Kai Wu is the founder and chief investment officer of Sparkline Capital, a hedge fund applying state-of-the-art machine learning to mine unstructured datasets with the aim to generate consistent alpha and profits. Prior to this, Kai co-founded and co-managed a quantitative hedge fund with $350 million in AUM, as well as having worked at GMO, where he was a member of Jeremy Grantham's $40 billion asset allocation team. Our discussion will center on investing, particularly value investing, in the machine age, how big tech and deep learning is disrupting traditional investment models, and how investors must heed these trends.
Great. Tonight we have Kai Wu, CEO and founder of Sparkline Capital. I am super excited and looking forward to this talk. I haven't met Kai for a long time, but since reading his pieces of research, especially August and September, I've been chasing him to give me an hour of his time to share his thoughts on investing. I really wanted to share Kai's insights with the book audience as well as the Wizards community, just because I read so much, I talk to so many investors, and Kai really has some amazing insights. So let's get started. Kai, perhaps you could tell us a bit about yourself and Sparkline Capital, and we'll go from there.
Sure, yeah. So my parents are from Taiwan. I was born and raised in the Boston suburbs and went to Harvard, initially focused on government, and I wanted to go into politics, but then quickly pivoted into economics because it was much more, let's call it, synergistic with my quantitative bent. And, I never really was interested in financial markets growing up, right? My dad's a doctor, my mom's an artist, and really only got my first exposure to business my sophomore year when I did an internship on Wall Street, actually, for Citigroup, in the M&A group. And, keep in mind that a lot of people grow up reading the Wall Street Journal, following Warren Buffett. I did none of this, right? I had no idea what banking even was until a recruiter showed up on campus and wrote me in. So that was a kind of eye-opening experience. And, keep in mind that this was during the teeth of the financial crisis. So, this is right during Lehman and Bear Stearns and all that. So super interesting. It kind of got my mind thinking more about financial crises. And I took a tutorial with a guy named Ken Rogoff, who later became my thesis advisor. And his focus, he wrote a book called This Time is Different, where he looked at hundreds of years of financial crises. And I ended up writing my thesis on this topic, where I kind of took an interesting kind of rebellious bent. I focused on Austrian economics and credit cycles, which, if you know anything about the Harvard economics department, is kind of the opposite of what they do. But look, the idea here was simple, which is maybe we can't predict the actual event that will catalyze a crisis, but we can focus on what the imbalances that build up are before that and say this is an unsustainable imbalance. So, think about classical economics focuses on equilibrium. Right? What I focused on was the fact that, look, we never really spend our time in equilibrium. We only really go to equilibrium when we're passing through, either from the top or the bottom. We spend most of our time in these cycles, either kind of above or below these, the kind of idea of self-reinforcing mechanisms and credit and asset prices, consumer confidence, all these things. And so that was kind of really what got me into macroeconomics and what ultimately led me to GMO. So Grantham Mayo Van Otterloo was the first firm I worked for at college. I joined right after the financial crisis, at which point the firm was doing extremely well. Jeremy Grantham, the founder, was very prescient in predicting the financial crisis, subprime, housing bubble, et cetera, and we did very well in the portfolios. And what kind of got me to my next phase in my evolution was the fact that GMO was actually, and you may not know this, had its roots in quantitative investing. So when Jeremy founded it with his two co-founders in the 70s, they're traditional stock pickers, but he quickly realized that there was a lot of value in using systematic factor-based investing. So he was one of the pioneers of the idea of value, small, kind of the fameux French factors that are now so popular. But he was doing this way before. And he, expanded it into international and emerging investing and then asset allocation. So valuing not just single stocks, but entire stock markets. And that's the group that I joined out of college. I spent 4 or 5 years there, left to start a new firm called Kaleidoscope Capital in Boston. We applied some of the same principles of top-down value-based investing, but we focused on more niche markets. So we traded options and off-the-run futures markets, things that GMO clients, given that GMO was a $100 billion firm at the time, would not really have been able to invest in. So these were kind of more niche, uncorrelated things. Firm grew. We had family office, endowment foundation clients, and I left in 2018 to start a new firm called Sparkline. And this is where I currently am, and in the process of building it up. But the idea here is to use advances in AI, and in particular natural language processing, to bridge some of the gaps that I see in investing today.
Amazing. So there's a lot there, and Jeremy Grantham of GMO is actually featured quite prominently in our book. So I have a lot of questions there. But let's more focus on you first. So tell us a bit more about Sparkline. Why did you start it, and what is the overall objective and business of Sparkline?
Got it. Yeah. So you think about my background, right? I come from the world of quantitative investing, right? Which is the idea of, can we find systematic principles, right? Think about Ray Dalio, universal and timeless principles that predict markets. So for instance, the traditional value factor, right, is simply saying, let's look for stocks that are cheap on price to book and bet on mean reversion, and then short expensive stocks on that factor. And historically, over 100 years, that premium has been rewarded, right? The same principles apply to momentum investing, growth, carry, roll down in the macro markets. So there are these repeatable ideas that you can kind of just run over and over again. And when you kind of roll it as enough times, your edge becomes apparent, right? So that's the school that I initially came from. But unfortunately, what's happened is while we have faster and faster computers and better and better algorithms, the returns to these strategies have, and this is no secret, have started to erode, right? And that's because, in my mind, these things have become commoditized. It's become too easy now to run these factors, right? So let's hold for a second and now focus on the opposite, which is there's a whole other school of investing, right? Discretionary investing. In the macro space, you can think of like George Soros. In stocks, obviously Warren Buffett comes to mind, right? These guys, they can theoretically look at all data, right? They can get on the calls with the management. They can talk to expert networks. They can follow the news, read the Wall Street Journal, do all these different things. But for them, the challenge is kind of the opposite, right? Which is, as we know, data is being created at an exponential rate. Right? More information is being created in the past year as of all of human history, right? And so you can just fast forward 10 years, and we're all kind of drowning in this ocean of data. And unless we update our toolkit, it's going to be very difficult to keep pace, right? So that's the setup, right? Which is, we have these two schools which are completely disjoint. They kind of don't talk to each other, and we have opposite problems. We both have one part of the puzzle, but can't solve it individually, right? And that's where I believe there's a huge opportunity, which is, can we actually marshal our technology prowess, machines, to process unstructured data, which is a kind of technical term for the information that discretionary investors look at, right? And one thing, Sam, I should mention is that unstructured data is 80% of information. So only 20% of data is in SQL databases or Excel spreadsheets. The other 80% is unstructured. It's text, it's audio, it's images. And by the way, that ratio has grown through time because data is being created at a faster rate than we can structure it. So it's almost just a matter of time before the information that quants look at, the structured data, price, volume, P ratios, becomes just such a sliver of the information that's available. And that's just not going to be a sustainable path. And so it's almost a necessity that we can do this. And that's what I've spent my time at Sparkline focused on, which is developing this toolkit, machine learning and AI, and in particular natural language processing, as a way of systematically going through the information and say, the MD&A section of a 10K, right? A Wall Street Journal article, taking this information and bringing it into a process by which it becomes accessible to a machine. That's a thing that's only really become available to investors in the past 2 years, right? And that's thanks a lot to spillovers from Silicon Valley, right? You have, the big tech companies doing a ton of great work, innovating in this space, but their goal, of course, is, tagging their friends in photos, not, and obviously, from our standpoint, where you and I sit, our goal would be to say, can we take this technology and translate it in a way that it becomes useful for our use case, which is namely finding good stocks.
Okay, so this is, as you know, I'm more focused on the value fundamental longer term side. So this is a bit new to me, but I think I'm following. So you're taking this massive volumes and growing volumes of data, unstructured data, and trying to make sense of it in your investments. Kai, can you give me and give my audience an example of, let's say, a recent trade / investment you did using this approach?
Sure. Yeah. When coronavirus first hit, right? So with that March, the narrative evolved through multiple phases. But if you remember, at the very beginning, it was very much focused on China, and to the extent that the virus in China would affect the supply chain of all these companies that relied on, say, manufacturing or intermediate goods from that area, right? Then after that, it evolved further. And then, you have the lockdown related issues, and you have all these different steps. And so I think for a lot of quantitative investors, it was very challenging because they were often, their risk models are very static, very backward looking, where you say, let's look at the historical correlations of stock prices and use that to predict where the risks lie. Now, one of the things that I've been doing is not using statistical risk models, but fundamental risk models. So in other words, defining risk vectors along the dimensions of things like China's supply chain. And in doing so, being able to pick out what is it that is driving the variance in markets, right? Because if you remember February and March, everything just moved to a ridiculous amount, and risk models, value at risk and all those things, metrics blew up. And a lot of traditional quant factors, right? So value investing, small cap investing, all these things that you expect to potentially hold up did not, right? And so this is kind of a long way of saying it's not so much a trade, I guess, but it's more by using natural language processing to look through textual documents, figure out each company's exposure to fundamental factors such as, again, China supply chain, being able to then isolate risks accordingly.
Okay, so can you translate that into an actual investment or a trade? So you're crunching all this data, you're trying to make some sense of it, and then what's the conclusion? What's the action from that? Mm-hmm.
Yeah. So let me give you, I guess, a better example that's probably more in line with the way that you probably think. So think about the shift, right? We all know, looking back, that the big thing that happened in coronavirus was a shift of demand from brick and mortar to online, right? With the benefit of hindsight, it's blindingly obvious, right? How could that not happen, right? This secular trend towards e-commerce, for instance, was only accelerated by the necessity of lockdown. Well, the criticism that quant models always get is that we can't predict the future, right? We're just looking at historical patterns, and just by definition, how can you predict a regime shift, right? But there's two things that I would say in response to that. So first of all, these are not kind of black swan events, right? The fact is, as I mentioned, that demand has been shifting online gradually for a long time, right? The retail apocalypse has been a theme that has been, in the kind of zeitgeist for decades now. And so this happens to be the acceleration of that theme, but it's the same thing. So as long as your portfolio is positioned to benefit from that, yeah, you get a little lucky that it happened faster than you expected, but it's still there. And then the other thing is measuring digital demand, right? One of the things that quants are good at, right, is being able to kind of keep tabs on a variety of real-time data sources, right? So, everyone knows about like Google Trends and transaction data, things like that. These are just specific examples, but there are many things that I'm looking at that are kind of real-time indicators that did actually show that consumers were shifting demand to these kind of online channels in real time, faster than, say, the quarterly earnings reports that companies are required to disclose, would have revealed. And so it's not so much, so the second piece is not so much being able to predict, but being able to react in a more nimble way than like a traditional analyst who, may or may not get it right. I'm sure there are plenty of people out there who are very clever and figured it out really quick, but then there are plenty of other people, and, the market obviously being the average of, everyone, all the different minds, being a little bit flat-footed in such an event.
Gotcha. Now that makes sense. So I think for those of us, myself included, that were in Asia during SARS, we lived through that, and we saw that companies like Ali and Tencent benefited from that episode. And so I think from a macro historical standpoint, it wouldn't be surprising if other, perhaps older investors might say, hey, digital makes sense. But what Sparkline does beyond sort of that macro intuition or history is you would collect sort of data that typically isn't used by, let's say, normal investor to sort of accelerate and prove that thesis. Would that be correct summary?
Yeah, and all these data points are things that, with the benefit of time, one could sit down with and be like, piece it together. Okay, so this is how the picture looks after kind of putting each piece of the puzzle together. The advantage of being a quant is you can just do it a lot quicker, and you can do it in real time. Versus most people, they're now putting it together kind of after the fact, being like, well, yeah, obviously this is what happened, but it's easier to say again with the benefit of hindsight.
Okay, so the Sparkline, what kind of data are you collecting? Are you like a Renaissance or GMO? You've got these massive computers, or are you more looking at specific pieces, or sort of a proprietary mix of data sets for your own trading or investing? Are you guys high tech, hard tech, or are you more proprietary? Yeah, I'm not sure if I'm asking the question, but I think you know what I mean, right? Are you competing with the big boys? Do you need to, or this is something different?
Yeah, I mean,
so I apologize. Let me rephrase. So when I imagine, as you said earlier, the large shops, the quant shops, have so much computing power. They're just feeding data into the system that a typical day trader cannot compete, right? So I have a relative who's a day trader. He's trying to learn the TA, and we keep saying it's really tough to compete against the big boys that have all that data already, right? Where does Sparkline fit?
Got it.
In that realm, yeah.
Yeah, I mean, again, I don't want to paint with too broad a brush, but it does tend to be the case that the characterization of these big quant firms who have reams and reams of data tend to be focused more on structured data, right? So.
Okay.
These guys, without naming any names, are the best at what they do, and they are, as you point out, doing probably a better job than the average day trader in executing thousands of trades across using higher frequency data or using a lot of structured data. So my focus has been a little bit different, right? Because I'm not trying to compete with them head on. That wouldn't make much sense since it's a losing battle. So instead, I'm saying, well, maybe not. Maybe I shouldn't focus on trying to build a better mousetrap and process structured data in a faster and more powerful way than those guys do. Instead, let's move to the other 80%, the kind of untapped resource of unstructured data that to the as far as I can tell, most of the big firms are not relying heavily on. So I think that would be the main distinction.
Gotcha. And I want to move on to your August and September pieces, Kai, but in your portfolio for Sparkline, are you investing in a stock? Are you investing in an ETF? What's the asset you're buying, and what's the holding period, and what's the typical portfolio size and the number of holdings?
Yeah, so the asset class is single name stocks.
Okay.
Apple,
okay.
That kind of stuff.
Gotcha.
Because ETFs are great and they're super liquid if that's your goal, is to trade a lot. The nice thing about single stocks is that you have more breadth.
Okay.
Because quant comes down to exploiting an edge over many at-bats. And the more at-bats you have, the less the variance, the less the noise, and the more the signal emerges. And so that answers your second question, which is how many names, right? It's going to be in the thousands.
Are you buying thousands of stocks?
Right.
Wow. Wow. Okay. And what's the holding period?
It varies. It varies. But
Typically, are you in and out the same day, or are you really
no.
buying these? No, no. These are long, like what, yearly holds or monthly holds, or it really all depends.
So probably more in the monthly range. And again, this comes down to where is the opportunity, right? Because high
Okay.
frequency trading, intraday trading is pretty competitive right now. And it's a bit of an arms race. And on the other hand, super long-term investing, it's hard to really get that many at-bats, right? Because you can, going back to the idea of at-bats, it's not just how many stocks you hold, it's also how many swings you have over the course of a given period of time. And if I only buy a stock and hold it for every 10 years, then it becomes a little bit challenging to get
Understood. Okay.
time series wise.
One of the 10 commandments in our book is diversify, don't over diversify, right? So 1,000 stock is a lot of stocks. So are the buy sells, most of these automated, triggered by criteria you set ahead of time? How do you manage 1,000 stocks as a small firm?
Well, it's all computerized, so it's the actual implementation is actually pretty trivial. But let's go back to your point. I think that's kind of interesting, right? You're saying one of the principles is to diversify, but not to over diversify, right?
Yes.
And so I guess kind of the interesting thing is that I don't believe that I'm over diversified, but I just view bets in a different way than, you know, a traditional person might, right? So the average person says, all right, well, I have 10 stocks, so I have 10 bets, right? What I'm saying is, well, imagine you had 10 stocks, but they're all like big tech names, right? Then you really just have one bet, which is I bet that big tech's going to do well versus not, right? You know, the big antitrust report came out yesterday, right? If the Democrats sweep and, you know, there's a paradigm shift in the way that, you know, the DOJ and FTC conduct their business, well, all those stocks are going to go down, right? So in a way, you're not diversified, even though you have 10 different things. So I'm thinking of things, you know, and I hate to use the word factor, but more in factor space, right? So for me, it's how many factors do I have exposure to, not so much how many names. And in fact, having more names allows me to diversify away idiosyncratic risk, which is the risk that, you know, I may be completely right that, say, value investing is going to work, but I just get caught up unlucky in like one stock that happens to go to zero for some fraud that is totally unrelated to what I'm doing. And so by having lots of names, you diversify away that, and you can isolate what are the actual factors that you care about. So, you know, digital demand, like what are the themes that matter? And, you know, on that dimension, you know, I don't have, I would say, as many as it might sound.
Okay, great. All right. Now let's get to your August letter. There's some amazing, and I would encourage whoever's listening or watching to please go to Sparkline, and Kai will give the address later and read that report. It's an easy read, but it's a fascinating read. Maybe Kai can just give us let's start with the August letter about the big tech eating value investing. Maybe tell us sort of that thesis, how you got to that, and maybe the key conclusions you drew and implications for value investors such as myself. I'm just excited to hear this. Yeah.
Right. So obviously value investing has a grand tradition. Kind of dates back to Ben Graham and security analysis in the 30s. And, you know, Graham was really interesting because he was actually, maybe you could argue, one of the first quants, where he really advocated for rules-based approaches to valuing companies. And, you know, you have to keep in mind that back in the day, most of the economy was industrial. So things were kind of hard, tangible assets. And so you look for things that were trading below that and you bought it, right? So it was maybe a little bit more simple than it is today. But regardless, that was the framework that a lot of quants, including my former boss, Jeremy, in the 70s and 80s pioneered, and has since then, you know, due to its massive success and the kind of academic support around it, become a huge industry, right? So many ETFs and mutual funds and active funds are all benchmarked to value benchmarks, right? And what that generally means, and obviously everyone's definition of value is different, but it generally means, you know, go long or overweight low price to book stocks and short or underweight high price to book stocks. And, you know, there are other ways of looking at this. You could look at price to cash flows, price to earnings, even to EBITDA. I mean, there's plenty of different ratios, but they're all pretty highly correlated. And what's happened is, you know, as money's flown in, unfortunately, performance hasn't been there. So over the past 13 years, the strategy defined in a variety of different ways, value investing has not worked. And, you know, what started as a slow trickle has become a torrent. And, you know, in fact, the performance has accelerated down and, you know, really culminated this year with COVID as just kind of being awful, right? So value has not done well the past 13 years. And so that's a setup. On the other hand, right, you we'll often hear people say, well, there are plenty of reasons that value is down, but one thing that I should point to is the fact that value looks cheap now, right? So, the portfolio of cheap stocks and the portfolio of expensive stocks. You can look at the spread between those two things and look at that through time. Well, it turns out that aside from the tech bubble, which we all know what happened after that, value stocks are the cheapest they've ever been, right? So 2 standard deviations cheap relative to that average spread. And so proponents of value will point to the fact that, hey, look, value is super cheap today, and it's positioned to have a massive historic rally, a 3x, run against growth. And maybe it will, but that's the kind of $1 million question, so to speak. And, there are people who have kind of lined themselves on both sides, and, it's super interesting. So the most common explanation that you'll hear as to why value has failed recently has been technology, right? Oh, well, value is just kind of buying all these value traps, these broken business models, putting all this money into Macy's and, shorting Amazon. Well, that actually might be true. But what's quite interesting is that whenever academic or quantitative researchers have tried to demonstrate that, they haven't been able to, right? And that's because what most people do is they rely on what we call industry classifications, right? So this is a static 1-0 mapping where each company is assigned to an industry. So for example, Google is a communications company, Apple is a technology company. But the thing is that companies can only be mapped to one thing at a time. So Tesla can either be an auto company or it can be a tech company. It can't be both, right? And when you actually decompose the constituents of the value index, right, what you find is that, yes, it's making a bet on short tech, but if you look at the names within the technology universe, really what it's doing is betting against the most disruptive technology companies and betting long the least disruptive ones, the kind of old economy tech companies. So, what my thesis going in is it's not so much that value is betting against technology, it's betting against disruption, right? And I'll get into the methodology in a second, but what I found is that if you're able to classify companies as either disruptive or non-disruptive, the value factor has a very strong short bet against this disruption factor, right? So another way of framing this is think about like the technology industry. Within the technology industry, there are disruptive companies and non-disruptive companies. Value is all things equal, picking the least disruptive companies within technology. And now go to like utilities or financials, some kind of old stodgy field. Well, it turns out that there are still disruptors in those industries. They happen to be a smaller percentage of those industries. And again, value is homing in on the least disruptive guys in each of these industries, and growth is the opposite, right? So what's quite interesting is if you can neutralize the performance of value to any factor, right? It's a standard quantitative thing. And if you neutralize value to the industry factor, so in other words, you only buy the cheapest stocks within technology, short the most expensive stocks within technology, etc., what you find is actually that value still underperforms. So industry neutralization defined by classifications is not helping. But then when you go out and you say, well, let's neutralize by these disruptive classifications, then you find it does explain 100% of the drawdown, right? So this is all just a long way of saying that, yes, actually the reason why value has failed the past 13 years is because it's been short these disruptive companies, but not that it's short technology per se, but just more that it's short the technological disruptors, whether they are, a company in the technology pure tech industry or the most disruptive company in, consumer staples.
Okay. So, Kai, where is this going? What's the trend going to be? Because it seems to me, unless regulators step in, which we're seeing now, right? Whenever monopolies become too powerful, especially in the software internet space where marginal cost is negligible or zero, it gets more and more concentrated to the big tech, big names, right? So what's the conclusion here? That big tech keeps eating the world and killing value unless somebody steps in? What's the implication for value investors, for investors overall?
So I think there's two things at play here, right? So let's separate the two issues at hand. First, we have disruptive technology. Let's put aside large caps. So actually the paper in August that I wrote I use equal weighted portfolios. And what that means is that I put as much weight on the 3,000th biggest name as the first biggest name, as Apple. So in other words, I explicitly try to avoid conflating the issue of monopoly power, which is the second thing, with technology. And so one thing that we're seeing, and this is what I talked about in the first paper in August, is that disruptive companies, small or large, are harming value. Value is making a bet against these guys, and that hasn't worked out well for them. The second point, which I make in the last paper, is on monopoly power. And the kind of interesting thing is that I started off by saying, all right, let's focus on big tech monopolies, right? How Amazon, Google, and Facebook and Apple are using their monopoly power to extract, rents, and in a way that becomes effectively impenetrable. The game is rigged against anyone who tries to take them down. Well, it turns out that thesis, that narrative, actually was not correct. And as I dug deeper, I realized that actually monopolies and this rise of monopoly power that we've seen has been happening before a lot of these tech companies were even founded, and has been so widespread it's across all industries, right? And so it's almost like a whole another thing. Yes, these mega cap tech stocks are kind of the pinnacle, the kind of best manifestation of it, because of the idea of scalability and technology, and how it is in itself a monopolist. It creates a winner-take-all dynamic, which kind of creates more concentration of power for monopolies. But what you're finding is that, whether it's airlines, beer, pharmacy benefit managers, I mean, so many industries, you're seeing basically 2 to 3 players control 80% of the market, right? So name a market, it's probably the case that 3 players control 80% of it, right? And that hasn't always been the case. It's been a process since the 80s, and due in part to changes in antitrust frameworks, but also just a wave of consolidation and potentially globalization and technology, these mega trends that have been occurring that have led to consolidation within each industry. And so for value investors, it's kind of a double whammy, right? Because now they're fighting against 2 things. So first, they are short disruption, which has been obviously challenging the past 10 years. And second, they're short monopoly, right? Because the market knows that these big companies have an advantage, right? The market is not dumb. It's like, yeah, of course, you shouldn't fight against Amazon. If you want to fight against Amazon, like, I don't want to buy you. And so that the valuations show that. And so just, putting aside even the technology aspect, value investors are effectively going to be long, numbers 4 to N in any industry, and short numbers 1 to 3. And that's a pretty tough trade.
Yeah, so I just read your September piece on monopolies. Like the August piece, there's a lot of great insights there. I think towards the end you talked about Berkshire Buffett really picking his portfolio based on monopolies, if not oligopolies, pretty much, right? Airlines, you mentioned the investment in credit cards and banks, really taking pieces of these, so that he is intentionally, unintentionally, really buying into the pricing power of those concentrated players.
Yeah,
right.
And I think it's worth just, for your listeners, talking again about that airline trade, right? So for years and years, Buffett sat there joking and making fun of airlines, right? He even said at one point that, if the Wright brothers had been shot out of the sky, it would have been they would have been doing a favor to investors down the line, because these companies were such money losers. And then what happened was, years of consolidation, when all these companies got merged into, 3 or 4 big companies that dominated 80% of, U.S. domestic flights. And suddenly they had pricing power. And then Buffett didn't just buy one of them, he bought all of them. He said, I'm going to put 10% of my money into each of the big 4 U.S. airlines. And by the way, that was a great trade, right? Because he recognized very clearly that what had happened was an industry that was initially a horrible money loser became quite attractive from an investment standpoint, because they had developed that concentration. And that was kind of what I talked about in the paper, is if you were to apply that again systematically across all industries through time, you generate also some positive excess returns.
So he did that with Coke, but not Pepsi. He bought Coke. He bought at one point, I think pre-COVID, when I looked at the last year's annual report, he had 14 bank stocks.
Yeah.
He had essentially the majority of the biggest bank financial stocks, right?
Yes.
Which, so you're saying essentially that's part of his strategy is to buy into the pricing power of a few, if not monopoly, sort of an oligopoly players.
Right. I mean, and he's said it himself, right? He's said that he's looking for companies that have pricing power, right? That are so, that the business model is so infallible that, your idiot nephew could run it. Those are the things that he looks for.
Yes, but looking at the various verticals, I think it hasn't really worked that well for Berkshire, though, right? If he didn't have Apple, it would be a really bad stock the last couple of years, certainly this year.
Except he made $65 billion on that trade.
I understood, but I'm saying so Apple obviously is the big tech monopoly in many ways, as your report says, but his other monopoly of pricing power plays really didn't work out that well. I mean, right, the stock and the portfolio has been lifted by Apple, really that one trade.
That's it. Yeah, I mean, and granted, it's a little bit unfair to be like, all right, I'm going to take your best trade away from you, because then, by definition,
Gotcha. It is a portfolio.
But that being said, that I think the question that I would ask, and I haven't run the analysis, is how did those other stocks do relative to their industry? So one thing to keep in mind is that financials have not done well. It's the flip side of the technology trade. And so, Buffett happens to be highly concentrated in financials for a variety of reasons. I'd be interested to ask, is the stock that he owns in the financials space,
that's fair.
The industry at large, in which case he does have alpha. He just happens to have made at least really incorrect bet on financials.
That makes sense. I mean, he's constructing a diversified portfolio, and as you said, you got to look at the overall, not just. So I think that's fair. I guess my question is, let's put Berkshire aside. Going forward, do you see tech monopoly plays being a bit more sustainable longer term versus other monopolistic plays or non-tech plays?
So I'd say yes in general, with the caveat that the 4 big companies that are kind of in the crosshairs of Congress, I would definitely be a little bit more wary of, right? Like, we know that governments are notorious for over-promising and under-delivering. So it's quite possible that nothing happens, right? And there's some kind of partisan bickering and nothing actually comes of this. But there is definitely political risk there, which is unique to these 4 firms. But there are plenty of tech monopolies that are monopolies in more niche markets that you do not have that same risk. And those companies I would actually be bullish on. And this is why, right? So think about what the explanation, and I talk about this in the paper as well, is for the rising concentration in industries. There's kind of 2 different narratives. On one hand, you could argue that it's these robber baron mentality companies that are going in and using predatory pricing and anti-competitive techniques to crush their competition and thereby secure a moat and be able to charge above market prices, right? Or squeeze suppliers, earn above market profits. Maybe more specific. On the other hand, the competing narrative is, look, we just happen to be living through a period in which technology and globalization are changing the world, right? Think about a world without globalization, where we each lived in our small towns and every town had their own, Walmart, own retailer, their own, factory, etc. Well, you have a captive market and you can only grow so big. What globalization does is it makes it into one massive market. And now it's like this big pond where, through competition, eventually it's winner take all, right? The spoils are larger for those who win. And then for everyone who can't win, gets crushed. And you think about technology, it's the same thing, right? Before the advent of like sound recording, we had, bands and singers and musicians who basically didn't compete with each other, right? Because if you're going to throw a wedding, you're going to have that band. Well, nowadays it's like we all just listen to Taylor Swift and that's pretty much it, right? And we're done, right? So, that's what's happened with technology. So technology and globalization are these forces that potentially are kind of creating this secular shift towards winner-take-all dynamics, towards monopoly dynamics, where maybe it doesn't even make sense to have more than 1 or 2 players in each industry. Right? Like, they're talking about breaking up tech monopolies. Well, let me ask you this, which is, are there synergies that we get? Are there economies of scale that we get as consumers only having to face off against, right? Like, a great example is financial exchanges. There's a few exchanges. Imagine there was like 1,000 financial exchanges. Liquidity would be fragmented. That may not be bad, but it's just something to point out. Or like imagine instead of having Facebook, there are 1,000 small Facebooks, and all your friends are scattered across different Facebooks. That would actually be a little bit annoying, wouldn't it? So, maybe you can make the argument that there are natural monopolies. And, this is just a simple economics point, which is in industries where there's high fixed costs relative to marginal costs. So, it takes a ton of money to build a nuclear power plant, a nuclear fusion plant, and then the marginal cost of an additional unit kilowatt hour is zero. Well, in those industries, maybe they should be a monopoly, and perhaps you regulate it in a different way than a more competitive arena. And technology is very much that way. Right? When I write a piece of software, the marginal cost of producing an additional unit of software is zero, but there's a huge amount of R&D that went up into setting it up front, and that's kind of the barrier to entry for anyone else who wants to take that from me.
Yeah, I think it's tricky. Obviously, as you stated just earlier, and also in your paper, this is not the first time that monopolies have emerged and exist and become dominating. You're younger, but I lived through the AT&T breakup, right? And so what you just said actually applies. Huge capex. There's a huge argument. There's a massive argument to keep it a monopoly because of efficiency and whatnot, right? But most countries have decided to go without oligopoly, right? Which seems to be the case. Obviously, prior to that, there's steel, but as your report says, there's many other oligopoly monopolies. My personal view is big tech internet. It's harder. It's harder because it's so integrated, right? Facebook wouldn't be Facebook without a lot of integrations, and similar to Google and similar to Amazon. So I'm not sure. What do you think? What's going to happen? What will be broken up eventually?
I don't know. I don't even know if anything's going to happen. I think there are different proposals, right? There's the idea of breaking up companies, and then there's the idea of like the Chinese wall equivalent, which is to like say, okay, so Amazon, you have this marketplace, and that's great. You can continue to run that, and you can have your own products, but you can't like use your privileged position here to take advantage of that. It's like the net neutrality, equivalent for.
Yeah. Do you see? Yeah, I think anything that's government driven would take decades, especially since big tech is global, it's pervasive, right? It's not like Google is just in America, right? It's quite integrated globally. Do you see any possibilities in the blockchain space with decentralization to potentially take some of this power away?
Well, I don't know. I mean, I actually traded crypto back in the day. This is really early days for crypto, but no, I haven't really been following the space. It remains to be seen, I guess. Blockchain seems interesting, but as long as all the servers that run it are on AWS, it's not truly free.
Well, yeah, I mean, the ideal of blockchain and Bitcoin with Satoshi is, it's tied to monopolies and power, right? In many ways, financial power and government power, and how everything's concentrated, or power concentrated. YouTube, paying a tax to YouTube, the Apple Store, and decentralization is supposed to be a way of getting around that. Still a lot of romance around that, a lot of activity. I'm just curious whether you've studied that and whether you think that is potentially one force that might mitigate the monopolies. But as you said, I don't know myself.
I don't know.
Okay. So back to August. Again, you make a really, value investing is obviously still a thing, a big thing. What's your advice to value investors? Give up and go to growth?
No, that's the worst possible thing you can do, right? Like that's the worst possible, and that's selling low, right? Definitely don't want to do that.
So I'm sorry. So let's say I'm a fund manager. I've raised a fund that's doing value, right? I'm getting my ass kicked by growth and tech. You see reversion? Do you see this keep ongoing for a while?
So I think it helps here to kind of decompose what are the reasons for the drawdown, right? And I already gave you two things. So first, being short disruption, and second, being short monopolies, right? So I think what you want to do is you want to say, what are all the things? And those are just two. I'm sure there are many other reasons. People talk about interest rates, accounting policies, blah, blah, blah. Come up with your list of different things is the first thing I would do. The second thing I would do is then say, for each one, do I believe this is a permanent shift or is this going to mean revert? Right? So the monopoly one's kind of a tough issue. I mean, I don't know where I stand on this, but I could see it mean reverting. I could also see it not. I don't know. I mean, I think we should see how the election goes. We should see how the Supreme Court appointment goes. I would, want to do a lot more work on the space, but that's an important question to answer. If I were a value investor, I'd be spending my time thinking about that. I would also be thinking a lot about, the valuations of tech companies in general. So put aside big tech companies, just in general, technology as a disruptive force, right? So you think about technology. Yes, companies that deal in cloud, deal in AI, robotics. These companies have sky high valuations, and they've done so well the past 10 years. And being underweight and short, these companies crushed you. But has it gone too far? Because you can think back to 2000, which you mentioned. I mean, you lived through, and that was kind of a case where yes, technology was very disruptive, but the narrative got overblown. Right? I mean, you look at this in the Bitcoin market all the time, right? I mean, there's all these big booms and busts and bubbles in Bitcoin as people get excited and then they kind of pull back, right? How it will end up, I don't know. But, you have to ask the question, which is the tech disruption narrative overdone? Maybe it is. Maybe it isn't. And, those are the questions I'd be answering. I'm not going to, profess to know the answer to all these questions, but I think that's a framework I would give a value investor for thinking about this because, the first step is just recognizing the implicit bets you're making. You're not just simply sitting there buying cheap stocks, selling expensive stocks. I wish it were that simple. What you're actually doing is you are, betting on these various themes that, may or may not mean revert. And in your job as an investor should be to know what you're doing and then to form views on all those things you're doing and, figure out how to adjust in each case, right? Because you can obviously tilt your portfolio in any way you want. If you thought, for instance, that technology was a secular trend, that you should not be betting against that, but you thought that big tech, that monopolies were going to mean revert, that antitrust was going to come in and quash them, right? Then what you would do is you tilt your portfolio to not to avoid the big tech names, but focus in on technology in general, and you kind of neutralize or remove your short bias towards technology, right? So you can kind of like pick each of these little pieces individually, depending on your individual views.
Let's push this a bit deeper. I just want to get more of your insights. So you mentioned three major trends. The 2009, late 90s, 2000.com. Yes, I lived through that. I was part of that. I raised 60 million for my own .com. That was a great story without profits and whatnot, right? So I think the headlines are saying quite often that today's big tech is different. It's driven by the monopoly guys with profits to show, right?
Yeah.
So I think I believe in the argument that this one is a bit more sustainable. Now, whether or not Apple should be 2 trillion versus 1 trillion, that's a valuation issue, but it's not a BS story, right? Yeah. You talked about big blockchain and crypto. I also spent 3 years not trading. I participated in ICOs, and I was looking for. I searched really hard for practical and real applications of blockchain technology, in particular in decentralized applications, because I think there's a lot of romance driving that, and if there's a way to use that technology to replace some of the things that are controlled by these monopolies, then maybe there's a case for it. That was 2017, 2018. To date, I still haven't seen a real decentralized application. I know there's a lot of activity, maybe it's coming. So given those three trends, and given what you said earlier, that size in technology begets more power, more pricing, more profits, then unless something like a decentralized blockchain and or the government comes in to squash the big tech, what stops them? And then circling back to value versus growth, what hope is there for value if there's nothing stopping tech?
Well, I think as a value investor, the other thing you can think about is how do you adapt for the world? So actually the current, let me give you a sneak preview. So the current thing we're working on right now is on intangible.
On what?
Intangible assets.
Okay, IP.
Because this is kind of the this is the theme that kind of is the undercurrent that's running through the idea of technology and scale. It's the idea that's running through value and, the teachings of Ben Graham all the way up to Buffett and the evolution of Buffett's strategy away from, just buying the cigar butts and all the way to what he's doing with, the greatest trade ever, the $65 billion he made on Apple, right? So the interesting thing is, if you look at just the high level data, and even just common sense will tell you this, that we live in a very different world than we lived in before. That intangibles used to be a very small amount of the value of US corporations and are now the majority of the value. Yet accounting rules have not changed, right? If you think about the balance sheet of Apple, right, it's, price to book is 25. And when Buffett bought it in 2016, its price to book was 4. So in other words, if book value is meant to be replacement cost, right, the tangible assets the company owns, Apple sits on a bunch of cash, as we know, some bonds, it has some offices and factories and things like that. So it has this much value. Well, there's this much value here, which is unexplained. And so traditional value would be like, wow, this stock Apple is super expensive. Why would I ever buy it? I should short the stock. But the question is, maybe we're missing something, right? Maybe it's the case that traditional financial accounting practices are missing the fact that there's a vast amount of intangible value that's not being recorded on the balance sheet, right? Whether that's the patents, the brand that Apple commands, the monopoly power that it's worked so hard to gain, say the App Store, the supply chain relationships it has, the loyalty amongst consumers, the variety of different things, maybe culture, organizational competencies that it's built through training and various investments, that those things are not being recorded. So while we capitalize investments in factories. So if I were to build a factory, right, that goes into my balance sheet and then gets depreciated each year. We don't capitalize intangible assets, and there are good reasons for why that might be the case. But the fact is that there's a huge chunk of the value of these knowledge economy businesses that are just missing. And so value investors are just naturally going to say, if all I'm looking at is price to book, and by the way, the same argument applies to price to sale, price to earnings, they're just going to be short these companies all day, right? So maybe what value investors need to do is recognize that it's not that value is broken. It's just that the metric they're using for intrinsic value, in general book value, which is what Fama French used, is broken. And that we no longer live in a world with hard assets, and we need to adapt for the fact that intangibles, brand, IP, all these different things are the majority of corporate assets now. And if we can figure out how to correctly capitalize that and value that, then we can now adjust our metrics, and we'll no longer be short Amazon all day, right? Maybe we still will be actually, but we won't be short as much. And we will find that a lot of things we used to hate, we now like. And the things that we, love, we now hate, right? Like banks. Why do value investors love financials so much? Well, it's because like all their assets are like literally just very neatly laid out on their balance sheets. And so it looks like they're not that expensive. But I mean, that's just their business model. And for us to penalize technology companies because their business model depends on technology and intangible assets, and to love financials because their business model relies on tangible financial assets, just doesn't really seem to make that much sense. And so perhaps that's what value investors need to do.
Yeah, it seems Wall Street analysts are always a few steps behind. So even when during the 2000.com, I was CEO of a internet telephony company, and going IPO, and the banks were pushing to have the telecom analysts cover us and write the research. And we, like every other internet company, saying, no, we're IP based, we're not, PSTN. Yeah. And we were fighting and selecting the bankers that would allow the internet analysts to cover us, right? So what you just said, I think you could apply to many current stocks. I think probably the noisiest and the most prominent one is Tesla, yeah. Right? The next time I read a Wall Street analyst compare headlines saying Tesla is now 8 times BMW value, I would puke, right? Because obviously that grabs headlines, but that's really not the story, right? Mm-hmm. And you're seeing some of the more sort of emerging players, like I think Kathy Wood from ARK Invest, makes out the case. She has analysts from software, from energy and auto and different sectors to try to put the pieces together to value Tesla, right? I mean, is this in line with what you're saying? Is value needs to adapt to what's happening, in particular in tech, because tech is so pervasive. Is that accurate? What you just said?
Yeah. Yeah. I mean,
Okay.
I think the idea of just saying let's buy things that are cheap relative to intrinsic value, as defined by the factories and widgets, machines that you have, is outdated, right?
Sure.
And I don't know about Tesla in specific, but in general, like technology companies, biotechs, anything that's more knowledge and information driven, IP driven, will certainly have this. Also, brands are super important, right? Like if I were to do a blind taste test of a bunch of different sodas, and I told you afterwards that one of them was called Coke, right? Suddenly that changes your perception of what you just did. And so, what is a Coke brand worth? It's worth a lot of money, right? And the same goes for many companies that have invested billions and billions of dollars in promoting their brands. And so you can't just value that at zero. That's super important too. And so all these things taken together, if you ignore it as a value investor, you're just naturally going to short all these things, right? By omission, you are short all these factors. And that is a very scary thing to be doing in the modern age.
I love this. I just love learning new insights and concepts. So thank you. I think tonight, just to maybe wrap up, we learned Kai has fantastic training from what we call an investment wizard, Jeremy Grantham's GMO fund, and then sort of evolve into the second hedge fund that you've started now, a Sparkline, which sounds amazingly promising. A lot of fresh ideas, at least to me. And I think another theme that we learned, again, I would encourage everyone to read the August letter, is really how big tech is disrupting the whole value investing space. It's something to worth looking at. And then your latest newsletter in September is talking about how it's quite profitable investing in monopolies, including Buffett and others. So amazing. Kai, how can our audience find you and find your research? Can you tell us, if you don't mind, how they can access your work?
Sure. Yeah. I mean, I would just go to my website. So it's www.sparklinecapital.com. That's SPARKLINE capital.com.
Gotcha.
If you want to talk to me personally, I have a contact form. You can just send me a note.
Okay. And again, I don't know if you're allowed to say it, but is your fund open for investing for investors? And if so, what type of investors? If you're not comfortable,
accreditation standards. If you want to talk, you can kind of reach out offline.
Great. Okay. All right. I can't wait for your October letter, and hopefully get you back here in a few months' time to learn more.
Well, yeah. Thanks a lot, San, for having me on the show. This has been, actually a really fun conversation for me. So, no better way for me to spend my Wednesday night talking to you.
Okay. Great. Thanks, Kai. Appreciate it.
Thank you.
Thank you for joining us. Please visit Wizards Institute to access the blog summary of today's session, to learn more about other speakers, and to network with other investment wizards. Wizards Institute, the #1 community to learn smart investing and financial freedom.